All right. So let's get into it. Here we are, y'all. It is just after earnings, reporting for Netflix, and I want to chop it up about that. Lessons learned about playing earnings if you're new to trading, especially trading options with the added risk and volatility there. But before we get into it, I gotta drop the disclaimer, the disclosure, just to make sure we're all on the same page, right? So please note that the following is not legal advice and is provided for informational and educational purposes only. Investing in securities carries a high degree of risk and can result in the loss of your entire investment. You should consult with a qualified financial advisor or legal professional before making any investment decisions. The information contained in this presentation does not constitute an offer or solicitation to buy or sell any securities or other financial instruments. Any opinions expressed in this presentation are subject to change without notice and should not be relied upon as a recommendation to buy or sell any securities. Please do your own due diligence and research before making any investment decisions. And with that being said, let's go ahead and kick it off. Let's talk about what happened today in the market. Let's talk about Netflix and the earnings and all that kind of stuff. This is Curtis G, and you are watching Passive Income University. So typically, these are dialogues, discussions exclusive that I do for my Discord community, PIU, aka Passive Income University. But every now and then, I like to chop it up and do something that's available for the public for y'all to watch on our YouTube channel. So you'll get a sneak peek of the Discord, which is right here. You can see all of the different channels that we have. We have a Passive Income University section, and then we've also got a section for if you're new to trading or you're new to investing. So there's a lot of resources that you can go through. I have a couple of courses that you can go through, as well as an assessment at the end. And then depending on how you do on the assessment, you can reach out to me. We can see how you scored, what areas, what subjects you need to kind of brush up on when it comes to either investing or trading. And then we can go step by step from there. But this is what I call the chill lobby. So everybody just comes in here, chills. You can put memes, music, whatever the case may be, new events, stuff like that. And then we've got the trading chat room where we go over our charting, our plays, what we're looking at, options contracts. We've got a whole bunch of different bots that are a part of the Discord in the community. So when you join, you get access to these bots and you can give them certain requests, commands, things of that nature to see what's going on. So like today specifically, wanted to look at the options activity for Netflix. And what we saw, this report, I had it generated by the bot about half an hour before the market closed or the market ended. And it was just basically showing this extreme, not extreme, but much more sentiment on the bullish side. So what we can see here for contracts that are expiring or were expiring tomorrow, there was much more call volume activity than there was put volume. And then the same thing on a pricing side, right? The call premium was, about 15 million more than the put premium. And even for next week expiration as well, the calls were beating the puts, or the bulls were at least indicated to be beating the bears, having more power, more strength. But as we know, Netflix did report earnings. So I'm going to bring up TradingView and we're going to take a look together at how that went, on how Netflix did on their numbers and what they reported, because it was very surprising the extreme volatility to the downside on Netflix today. So we're opening up TradingView. I've got my participant list over here on the right hand side, just trying to keep an eye on if any members of PIU join, because I want to make sure I give them value, answer their questions, things of that nature. But let's just give TradingView a moment to load up and let's see what's going on here. Got all these tabs, so I can probably close a few. We'll close a few and we'll take this step by step, one at a time. All right, let's see. Let's see what's going on. Let us see what's going on. All right, so while that is loading up, we will give it a minute. In the meantime, in between time, let's go and take a look at the Discord. So with Passive Income University, the first 30 days are free. And then after that, it is just $10 a month. And you get access to all of our recorded videos in the past, all of our courses, all of the resources that we have available. And you get a community of people that are working together to improve their investing and trading techniques, strategies, learning about the stock market. But even more importantly than that, the goal of Passive Income University is in the name itself. It's really to help cultivate a community of people that are looking to build passive income portfolios. So whether it's through dividend stocks, getting rental properties, maybe buying and owning a business, or anything of that nature, where can you take your funds, your money, extra money, and where can you allocate it to? Where can you deploy it to build a passive income portfolio so that someday in the near future, we're not having to trade our time for money working our 9 to 5s and our gigs, our jobs. And this isn't to say that there's anything wrong with working a 9 to 5, not by a long shot. But we are in an environment in a time where one 9 to 5 just isn't enough. And there's only so many hours in a day that we can physically work as human beings before we need space and time and bandwidth to take care of our livelihoods. So the key here is to build up assets, to build a portfolio that will help give us our time back in the future. And that's done through passive income. So let's go back to TradingView. Here we've got TradingView open. This is Apple. Now let's take a look at Netflix. So here we go. This is the 30-minute chart. I like to trade on the 30-minute chart. I'm what's known as a scalper. And here is the 30-minute chart for Netflix. I'll exit out of this. And so first in TradingView, we'll just hover over this icon here at the bottom, which is the earnings indicator icon. And Netflix did report earnings after the market closed today. And what do we see? They beat their earnings per share or EPS estimate by 16, almost 17%. And they also beat their revenue estimate by 1% or roughly $95 million, $96 million. But even with strong reportings, even with that being said, here we have in this after hours activity in this first 30-minute candle, extreme volatility. Netflix shot up to about $40 a share, $41 a share, something like that. Came right back down and then just kind of flattened out and is down in this gap area from days and days and go. But this was extremely surprising for me. You know, I'm not naive and not blind to the fact that Netflix, or not Netflix, but playing earnings is a gamble. Even if you are a top tier trader, you have your technical analysis skill set down pat, trading earnings is like a lotto play or a gamble, because even outside of the technical indicator, even outside of the fundamentals and the business model of the company, all it takes is one small variable, one small factor that the market does not like that will completely topple your earnings play, whether you're looking for upside or downside. And that's just within whatever the company CEO or the C suite or the board of directors or whatever they put in the earnings play. But even if you get the earnings right, the direction will say when it comes to options trading, even if you get the direction right, whether you think it's going to be moved to the upside or the downside, what makes playing earnings even more tricky as an options trader is the fact that you also have to get the impact, if you will, even more correct, meaning that you got to buy things deep in the money depending on which way you're looking at it. So there's times where I played earnings in the past. I was correct in my thought process, my research, my prediction, however you want to say it. And I think, okay, this particular company, I have a strong belief that they're going to beat earnings. That's also aligned with the technicals. The chart is set up for an upside move. But even though I got calls and even though there was an upside move, it wasn't an upside move high enough. And the contracts that I got with options still lost value. So I learned that lesson very, very hard, that you are definitely want to play, if you can afford it with the contracts, play in the money options. But then, like I just said a moment ago, you have small variables that can completely topple the earnings play. And in this case with Netflix today, it was the fact that they made one change, a significant change that was very important to their subscribers, their investors, more importantly, which is the fact that going into the future, Netflix is no longer going to report the number of new subscribers that they got quarter over quarter. So starting next quarter, I believe 2025, they're not going to tell us on a quarterly basis how many new subscribers they got. Now, a lot of the market sentiment reacted to this very, very bad, because since the start of Netflix, especially when they IPO'd and became public, the company has always provided the number of subscribers that they've gained or lost on a quarterly basis. And this has been a very, very important metric that Netflix has leaned upon in terms of their investor sentiment. And now that they're taking it away, investors feel like they're hiding something. But that's not what I believe. And I've heard a couple of other YouTubers that I follow and other investors that I follow say something that I really, really agree with. You can look at Netflix the same way Amazon and Apple is. Amazon doesn't report to us how many new Prime members they got quarter over quarter, but we know the company does a stellar job at growing revenues, having profitability and things of that nature, growing cash flow, free cash flow. Same thing with Apple. There was a time with Apple years ago where they said, hey, we're no longer going to report the actual number of units sold, right? Whether it's the iPhone, the watch, whatever the case may be. We're just going to report on revenue and profitability. The same thing with Netflix right now. I don't think them not reporting how many subscribers is a bad thing per se. I don't think they necessarily are trying to say and indicate to the market, hey, we're at the top. We don't have any more room for subscriber growth. And one reason why I believe that is because Netflix has already said that they've got wider market share in countries or continents like Africa or India. There's way, way, way more market share for them to get where they're only representative less than 10% in these different footprints, if you will. So I don't think it's a matter of them peaking on the number of subscribers. I think it's a matter of them now learning how to get revenue outside of just having new people sign up. What we also see is that with Netflix, they're doing advertisements now. So if you have a particular tiered subscription plan, you're going to see ads in the shows and the movies that you watch on Netflix, which means they're going to get revenue from advertisers, brands, things of that nature. On top of that, they also have partnerships with other companies. They also have a partnership with T-Mobile, where their subscribers, their customers will be able to get Netflix subscription plans, and there's backdoor dealings and how they work out that partnership agreement. So the long and short of my thesis or hypothesis with Netflix is, even though the market has reacted quite negatively, what we can see over here in after hours trading, Netflix is down 29, almost $30, almost 5%. Even though investors are reacting poorly to it, I don't think it's a bad thing. I think what Netflix is saying is that as a business, we are maturing. We have matured as a business, and telling you the number of new subscribers that we got is no longer going to be the biggest translation for revenue growth. So just imagine if they don't have an increase in subscribers, but they've sold billions of dollars or hundreds of millions of dollars in advertising, there's no reason to really look at the number of new subscribers because they're still getting revenue. They found a new source of revenue outside of being directly tied to the number of people that have signed up. So just some things to consider there when it comes to Netflix. Definitely a hard lesson learned, and definitely a reminder that if you are playing earnings, no matter how much the technicals may be lined up, no matter how much research you may know in terms of understanding what's going on with a particular company, their market, and their business model, all it takes is one thing that investors, the powers that be, the market makers don't like about a company for the whole entire earnings play to be toppled. But that's what we're here to learn together in Passive Income University, whether it's on the long-term portfolio side or it's on the short-term trading side. So with that being said, let's jump into a couple of other things. We're looking at Netflix, just a quick summary on that. And now we could take a look at SPY and see if we see any plays coming up for the rest of the week, going into next week, things of that nature. Let's just see what we got going on. All right, want to make sure that nobody's trying to get in the PIU side. Want to see what's up, what's up, what's up. All right, so here's the daily chart for SPY. I think I'm going to start off fresh with some marking up my chart. All right, so we've had this kind of peak. It looks like in this current little rise and fall, this little mountain high, as I like to call them, in this valley low. Our last high, if you will, was on March 28th. So the end of March, the end of the first quarter. And we've, for the most part, just kind of been falling down. We've gone from a high of, let's just take a look. We've gone from a high of 524 some odd dollars, and we are down to below 500. So with that being said, and we got a little bit of a downturn even in after hours trading. It looks like this gap has been completely filled or is trying to fill. So I'm going to remark this. It was already on the chart, but we're going to do it fresh. Now, one thing I will say about gap fills, at the very beginning when I first got into trading, I definitely gave a lot of credence to this style of this trading style, right? Looking for gap fills. But I've also seen, at least in my experience in recent times this past year, that gap fills actually act as buffers now. Before price would want to gravitate and come back and close the gap pretty soon. But now, depending on when the gap happens and how wide the gap is, the gap can be there for quite a long time. For instance, and I probably bring this up in a second, but I was trading Pfizer because I saw that Pfizer was back down into pandemic levels. So the price of Pfizer was right about where it was trading in March of 2020. And there was a gap that was created all the way even before then in 2013. So over 10 years later, Pfizer closed the gap that was formed a long time ago. So I've really kind of seen, at least in my trading, that gaps act as places where price no longer even wants to go, at least in the short term. And so what we see here is this gap that was created on March or February 21st going into February 22nd. And for the longest time, almost 2 months, we'll say a month and a half, or it's the 18th today, so we can almost say 2 months. Now the market is finally trying to close this gap, and it may continue to close it tomorrow. We'll see. But it's definitely trying to get down there. So at least with this initial look, we have a little bit of bearish sentiment if price still wants to continue to come down and close this gap. Now, so in terms of a play for tomorrow, I'm thinking for maybe coming down to close this gap and acting as a bounce to come up. We can kind of take a look, not that, things are direct indicators of each other, but let's take a look at Pfizer, like I was saying, and see what it did in these last couple of days in terms of closing that gap that I saw from 2013. Let's double check. Let's make sure. Anybody in the chill lobby want to come through in here? Okay, okay. Good, good, good. All right, so we drop that in there. And let's go. Let's go. Now I got to put this on the. It's weird because you could really only see the gap on the daily, but we're going to have to put it on the monthly to go back and really identify how long this gap is. So when I do my charting, I do my gaps, I shade them with white. In orange shading is where I've identified either support and resistance zones. And then in white shading, the white rectangles, the white areas is where I identify gaps. So like I said, this gap was way back from 2013, which is what we could see here on TradingView. And look, all the way forward over 10 years later, it finally came down and closed this gap. Now, this kind of observation definitely does precede my recent kind of like notice that I've noticed with gaps, but it does add to this theory that I'm starting to see. Gaps now are acting as places where price really doesn't want to go. See, before when we would see a gap, we would think that, okay, price will eventually want to gravitate back towards it. But I'm really starting to see, I think price doesn't want to be, whether it's the market makers manipulating it or whatever the case may be, price doesn't want to be in that area. But it really was kind of a remarkable thing because when it comes to trading, every day you're going to learn something new. So it was remarkable for me to see this and to catch this, that after all these years, Pfizer wanted to close this PFE right here, wanted to close this gap. So let me see if I can do a little quick zoom in right here, right? And then let's see if we can change this down to the day. Will it stay where it needs to stay? Will it stay where it needs to stay on the day? It doesn't quite look like it, so we might have to use the replay tool. Yeah, because it went to the future. But anyways, just to show y'all that really quick, how that looked. Pfizer tried to close this gap. Look, even look at this one in 2020. Obviously, this was the pandemic. It even tried to come down and get in this area to close, but it acted as a level of support, if you will. Got super extremely close back at the end of 2023, as we can see, peep over here. So yeah, just something to notice. But I'm gonna go ahead and close out of that and come back to our SPY. So we've got this gap. We'll close that what I was saving. It looks like it wants to come down and fill it. So I'm thinking maybe puts to kick it off initially tomorrow, or maybe it might start off a little bit bullish in the morning and then finally come down and close it. So I'll be looking for I'll be more focused, not biased, but I'm going to be more focused on, a signal or indicator that the market is going to turn to the downside, at least SPY, to come on down and finish closing the gap. But whatever the market presents to me, That's what I'm going to take. I'm not going to let a bias blind me. So if it's looking bullish tomorrow, then you know I'm going to scalp some calls. If it's looking bearish, then you know I'm going to scalp some puts. And then typically QQQ, we know, follows the same train of thought or the same line of thought when it comes to SPY. This is the 30-minute chart, but for the most part, it follows the same thing. Looks like there was some type of a gap formed. Let's make sure we're not missing anything else. So this gap was closed that QQQ have formed back in February, similar to SPY. And look, it is now closed. So maybe SPY will do the same thing. We'll see. After hours trading down a little bit over here. All right, all right. I did call out today a good play on Shopify. Quick little scalp, right? Perfectly in alignment with my trading style, my trading strategy. So, like I said, I like to trade on the 30-minute chart. Here's the 30-minute chart for Shopify. Ticker symbol S as in Sam, H as in Harry, O as in Oscar, P as in Patty. And so we had this attempt, this nice, strong, bullish attempt at the beginning of the day for Shopify to try to reach the previous day, yesterday's high. It didn't quite get there. And then we formed this inverted bullish hammer, or a bullish shooter, if you will. And just these two factors alone were a pretty strong indication to me that we were going to have a push down to the downside. That alone. And on top of the general bearish market sentiment that we're in right now with the overall market, those three things were an alert to me to go ahead and take puts. And so I got in on this candle, actually slipped up and got in just a bit late. And so we continued to drop down. I wasn't greedy, very thankful for that. Got out. I typically aim for about 5% profit when it comes to scalping. So got my 5% profit and got out. But had I stayed on, or I let some winners run, which is an improvement area for me, I'm trying to get better and better at leaving a few contracts to let them run. I could have got some more profit, but hey, profit is profit, a win is a win, and it's better to get out and not get burned from being greedy. But I did alert it to the Discord. So that's the thing, man. So at Passive Income University, like I said, you get all of this information, all of this detail. We all trade ideas in here. You get the first 30 days free, and then it's just $10 a month. And so we could go take a look at the trading chat room. And we can see from earlier today that, where's it at? Where's it at? I got the notations right here. I let the community know that I was getting into the Shopify puts, and in about 1 hour made about $100. Now, here's the thing about the money made, right? When you get into trading and you start to have these days where you're making a lot of money very quickly, especially money that you're not used to getting, especially when you compare it to your 9 to 5, it can warp your sense of time and money. Now, while there's a lot of people that might scoff and laugh at this $100 trade, I had to remind myself and humble myself to say the average American is only making about $34 to $35 an hour in present time. The average American on their gig, their job, is making about $34 to $35 in an hour. I made almost 3 times that amount in less than an hour. So I keep those types of things in my mind when I start to lean and tip over and feel like I'm not appreciative enough of what happened or what I was able to get for the day. So this is extremely positive and extremely happy. This was like the perfect trade. It was a bit longer than I anticipate. Most of my winning trades are 10 minutes or less. I was actually in this trade for, 4 or 5 times the length of time I am used to. But like I said, it was still under an hour, as you can see with the timestamps here, 8:38, 9:36. So in under an hour, $100. Can't complain because I usually would have to work 3-4 hours to get this amount of money anyway. So definitely keep that in mind as you're getting into trading and you start to experience more consistent success, and you have these days where you make a quick 100, 200, 300, 400, $500, and you want to get more and more and more, and you're like, dang, I see such and such just made $1,000, or I wish this was 700, or whatever the case may be. Just keep in mind, making that amount of money in such a short amount of time, most Americans are not experiencing that. So just keep that in mind, so it keeps you balanced and even killed. I'm not saying that you shouldn't be more aggressive with your ambitions and that you shouldn't chase new milestones, because it keeps you hungry and it keeps you going, but don't get so warped in the sense that you're not happy with what you get. This is $100 that all I had to do was some charting, click the buttons, Be patient and get out. All right, all right. So let's make sure nobody else is trying to get in. We don't have anybody. All right, for sure, for sure. And so another thing I want to talk about is a little bit of investing. So, like I said, it's all about passive income with the Passive Income University, aka PIU. And one thing I've been getting back into is my dividends bag. My dividends bag. So, when it comes to researching dividend paying stocks, I always start off at this website, Seeking Alpha. And then from Seeking Alpha, I go into other websites and I roll up my sleeves and I get more into the research. So now that I'm getting back into my dividend bag, one company that I'm looking to add to my dividend portfolio is ADP, which is Automatic Data Processing. I think most of us have heard of this company. A lot of big companies across the nation use ADP for their payroll services. I looked at one of their investor presentations, and they report that 1 out of every 5 businesses in the US use ADP for their payroll services. Now, within the past year, they're up 11%. Year to date, they're up just under 4%. They're currently going for $242 a share, which is a little chunk below their 52-week high. So it's not like you're paying the most expensive price in relation to the past year if you were to get in right now. But if you're new to dividend investing and new to doing the research, like I was saying, I always start off with Seeking Alpha. I take a look at the numbers and I start off with their dividend scorecard because I want to see from the scorecard level, is it even worth it for me to continue to roll up my sleeve and look at this company? So we see with ADP, they've had dividend growth for the last 25 years. So what that means is every year for the last 25 years, ADP has raised their dividend payouts to their shareholders. So just imagine you invested in ADP 25 years ago, and without you having to do anything, you're getting a raise every single year. And they've been doing that for the last 25 years. Now, the next thing I'll take a look at is the 5-year growth rate, right? So the 5-year growth rate is Seeking Alpha analyzing how much has the dividend grown in the last 5 years. And in the last 5 years, the dividend has grown 12.36%. So just imagine in the last 5 years, you've gotten a 12% raise, which is super dope. Now, for those of us that are new, the next thing that we want to talk about is the payout ratio. Now, the payout ratio, I'm going to keep this very simple, is related to how much money is the company paying out to their shareholders in the form of dividends. And we really want this percentage, this number, to be lower. We want it to be far away from 100%. So you could look at it like this. For every $100 that ADP makes, they're paying out about $59 to $60 in the form of dividends. Now, you may think as a dividend investor, hey, that's good. But now you got to remember that leaves them with about $40 to grow the business, develop new products and services, expand, work on marketing, all that kind of stuff. So when you're looking to invest in a company, when it comes to dividend investing, you typically do not want to see this number close to 100. And now there are some specific cases that there are exceptions to. Companies that are qualified as REITs, real estate investment trust, REIT, or BDCs, that's business development companies. Those types of companies have agreements with the IRS that say most of their revenue needs to be paid out to their shareholders in the form of dividends. So those type of companies, you're going to see payout ratios that are 75%, 80%, and that makes sense. But for regular companies, we don't want the payout ratio to be that high. And just as a good rule of thumb, it's ideal to see a payout ratio of 50% and below. But I'm not really looking at 59% for ADP as a red flag, but just want to make sure we're all on the same page there. Now, we also have the dividend yield. Dividend yield means for every $100 of this company that you buy, that's how much you're going to make per year in dividends, just to keep the number simple. So if you bought $100 worth of ADP, each year you're going to get $2.31 in dividend payments. Then down here, the amount tells you how much you're going to get per share per the frequency. How often do they pay out, which is on a quarterly basis. So if you bought 1 share of ADP, which is $241, you'd get $1.40 in dividend income every quarter or once every 3 months. So don't let that confuse you. I just used the $100 in the dividend yield to keep the math simple. You can definitely buy fractions of a share depending on your broker. I know with Fidelity and TD Ameritrade and companies like that, you can buy fractions of a share. I'm almost positive. I think you can possibly do so on Robinhood too. But that's why I use $100 just to keep the number simple, right? So if you were only to buy $100 or a portion of one share, you'd get $2.31 per year. Or if you were to buy a full share, you would get $1.40 once every 3 months or once every quarter. And then you would just multiply that by 4 to get you how much you would get per year. So that's the first thing I do. And if the dividend scorecard is looking really, really good, then the next thing I do is I go and I take a look at the financials, right? So we'll go over to the financials. And I really don't allow myself to get blinded by revenue. Even though revenue can increase or decrease, one thing or one way that I look at revenue is like this. If I buy $100 million in widgets and I sell them for $100 million, I could report that I made $100 million in revenue. You might be looking at Curtis G and being like, damn, like he's got it popping. He made $100 million, but that's not profit. So what I like to focus on is more so on the cash flow side of the business, which has become very, very important for investors, especially new investors. You want to familiarize yourself with the cash flow of the company. And so now what we want to take a look at is net income. And that's just basically a simple term for profits, if you will. Now, there's a lot of ways to calculate profit, whether or not you want to include expenses and taxes, EBITDA, or different things like that. But the long and short of it is you can just look at net income for a rough idea of the profitability of a company. And now what I like to do is I like to see year over year that they're growing their profit, their net income. And that's what we can see with ADP, even through the pandemic right here. So in 2019, it was 2.2 billion. 2020, 2.4, 2021, 2.5, 2022, 2.9, 2023, 3.4. And then TTM stands for trailing 12 months. In the last trailing 12 months, it's forecasted that they made about $3.5 billion in profit. So that's a good sign there. So everything that I've seen so far from the dividend scorecard, them increasing their dividend for so many years, the payout ratio is pretty healthy. The net income, the profitability has been increasing year over year, at least for the last 5 years. So far, so good. And then the next thing I want to take a look at, and all these numbers are important, but for a beginner investor, especially if you're looking to get into dividends, I want to focus on the high level numbers that you immediately want to gravitate to when you're researching a company. And the next thing we want to look at on the cash flow side is their free cash flow. And here on Seeking Alpha, this is why I like using Seeking Alpha, because it makes all of these numbers very easy to identify, to access, and to summarize, as opposed to going to the company's investor website directly and then having to filter through and read through all their reports. They summarize it all very, very easy. So here, the next thing we want to look at is free cash flow. So we've got the unlevered free cash flow, and then we've got the levered free cash flow. And basically, levered free cash flow includes their debt obligations, and then unlevered free cash flow does not account for their debt obligations. And we want to see this number increase as well. And if you want to get an understanding of what free cash flow means, here's an oversimplified definition or example that helps me make sense in my mind. Think about the amount of money that you have at any one given time to help pay your bills, right? That's your cash flow. Most of us are working on bi-weekly paychecks, right? We get paid once every 2 weeks, but expenses pop up all the time. And so if you don't have enough cash flow coming in rapidly, you might find yourself having to use a credit card to pay your debts or to pay that expense or borrow or whatever the case may be, or waiting till the next payday before you could take care of something that you need for your household or for your daily life. But if you're constantly getting paid and you got a lot of free cash flow, whenever an unexpected expense pops up, you can knock it out right away without having to rely on a credit card or rely on waiting until you get paid again. And so that's essentially overly simplified how I look at free cash flow. And what we see, same thing with their net income, is we've got some steady increases. 2019, just under $2 billion. 2020, 2.2 billion. 2021, 3.6. 2022, 5. We had a slight dip down, coming down under the high 4 billions, just under 5 billion. And then it looks like in these last trailing 12 months, we're at 3 and some odd change. But remember, we're in April, so we got the rest of the year to really see if this number beats this, which, I mean, it looks like it's forecasted to do so already. So the free cash flow looks good. They've got cash on hand to take care of unexpected expenses and just kind of equate that to your daily life. How much cash on hand that's rapidly coming in are you getting to take care of these expenses? So these numbers look good to me. And then the next step is to go to the company's website and just take a look at what their outlook is. What are they saying their challenges are? What are they saying their projects are for the future? What's their forecast? What do they plan on doing? Things of that nature, to see if you really want to invest. And then you want to cast your net out even wider and start understanding some of their peers, some of their competition. Start seeing how that industry looks. Is it something that AI is going to disrupt? Is this something that another competitor could come in and take market share from them? Things of that nature. So let's take a quick look at ADP because, like I said, I'm strongly leaning towards adding this to my dividend portfolio. So fortunately, Seeking Alpha also has the direct website. Now, while we pull that up, another thing popped up in my head. Let's make sure, okay, we got nobody else coming through. That's what's up. With that being said, we're at the ADP website. Let's see if we can go down to where their investor relations is at. Let's see where they're at. Usually you scroll to the bottom of the website and let's get it because we just want to take a look at a couple of things. All right, investors. All right. So they've got an investor presentation. We can open that up. And I think this is just where like kind of they brag about themselves, right? So you got to look at these things with a critical eye because they just want to say, what's popping about them. So they got this company overview. So it says it's the leader in human capital management software and solutions. They got over 1 million clients in 140 countries, 60,000 global ADP associates, and they deliver payroll for over 41 million workers globally. 25 million plus in the US. That's 1 in every 6 US workers has their capital management through the company they work for is through ADP. 15 million is outside of the US, and they've helped to move $3.1 trillion of US payroll taxes on behalf of their clients. And it was in the fiscal year 23. And they are a category leader in most of the markets in which they participate. And so we can come down here. So I wanted to show some other things. So their market is big. They're saying that their total addressable market is worth about $150 billion. And their market is expected to grow 5 to 6%. So just different things, high level. They like to give us the key numbers just so they can kind of like brag a little bit and get you excited about investing in the company. These type of things you really want to kind of pay attention to, roll up your sleeves and ask yourself some critical thinking questions, especially when we're thinking about, is there a way that AI can disrupt this? Can AI or new developing technologies empower most people to handle their own human capital management, their own payroll, their own things like that ADP does provide? So all in all, this is just the top level, giving you guys some of the initial research that I do when I'm looking to invest in a dividend company. And I wanted to share that with you so you had some tangible steps that you could follow when investing. But I appreciate y'all for rocking with your boy. We went over what happened with Netflix earnings, just a real high level, looking at the chart. We went over potentially adding ADP. And if you go ahead and join Passive Income University, you'll get the alerts on the companies that I do invest in and how I'm managing my long-term dividend portfolio. All right, y'all. Passive income for the win. Peace.